everyone. My name is Perry, and welcome to Perry's PIIverse, the channel that basically explores my journey through my income investing, which I'd like to share with everybody else and hopefully help educate or, entertain if nothing else. So anyways, we're hopefully going to have another exciting video here that I'm releasing today. And the topic is going to be mastering income and NAV growth with no compromises. How reinvesting will grow NAV, which then earns more income, and then rinse and repeat. I'm hoping you guys are going to enjoy this video. And without further ado, let's get started on this. Okay. Again, before we start, I want to make sure and notice to all viewers, I am not a licensed or trained financial or investment expert. I'm just an average retail investor with a passion for investing, sharing what I've learned along the way of my own investing journey. As such, viewers must not take any of this content, thoughts, opinions shared in this video as financial advice. Always do your own research and seek professional financial investment advice from a certified expert before investing. This content is for fun and entertainment only, so I hope that this will basically educate you and, if nothing else, entertain you. Anyway, thank you very much, and let's get moving on. All right, we're going to start with the agenda. And the agenda basically is going to start with an introduction on what this video is all about and what's spawned this video. We're going to then proceed with an overview of my PIIverse income strategy, which is critical to this video. If you don't understand that PIIverse income strategy video that I had, then I got to get you up to speed on that. Then also I'm going to talk about some important terms that are going to be explained related to the topic. And then the next one is going to be how income and NAV expansion cycle. I want to explain and actually visualize the income NAV expansion cycle. Follow that is going to be a book NAV growth, how the role of monthly reinvesting works with my book NAV growth. And then followed up by current NAV alignment to the book NAV. Followed by an angel share, current NAV lag. And I'm going to explain what the angel share means. It's actually an analogy, and I will talk about that a little later. But there's a whole slide that basically, hopefully, will paint a more human-centric view of what I'm trying to talk about. Finally, we're going to talk about market resilience. A lot of people have been talking about what about downturns? So I want to tackle in this video how NAV and that is actually dealt with regards to riding the downturns and how to get through into the recoveries. All right, and then some final conclusions. So let's move on. All right, so we're going to talk into the introduction here. So over the past several weeks, I have released several videos that explained a few things. So one of them was my PIIverse playbook, which is a complete covered call ETF-based income strategy. I'm hoping you guys could see it right here. This is what the image looks like. Then the other one is going to be my concepts of treating covered call ETFs as if they were annuities. And you can see that image there of one of those videos. And then the third one is the follow-up video that I did just recently on, but what about NAV erosion, which is the one you can see there that's called Let's Talk. I will provide a link to each of them in the description so that if you're interested in watching them, please do. And if nothing else, then we'll move on. All right, but reading all the comments, and I tried to read all the comments on all my videos. It's not easy because we had hundreds of them. There's a lingering main concern brought up by a few viewers about how do you deal with NAV erosion. It keeps coming up over and over. There are people there that not only questioning about how does NAV erosion happen. There's people that actually believe it does happen. So I want to tackle that one head on. I keep repeating myself in my that my portfolio does not experience NAV erosion, but it has somehow not been clear to some of these viewers, or it's just, that there isn't any. And I just want to hope that maybe this video is going to help try to tackle that my portfolio does not experience NAV erosion. And I'm going to hopefully explain to you visually so that you can understand why I'm saying that. Also, there's some of you that have called me out saying, how are you not worried about NAV? And so this video is also going to talk about why I am not concerned about NAV. All right. I created this video in basically hopes of making both of these points very clear. That one, there is no NAV erosion in my strategy and why there isn't. And then also, why am I not worried about my portfolio's NAV? I'm not worried about erosion. I'm saying that I'm not worried about the NAV in my portfolio, and you'll see why. Something I'm going to point out, and it's a little bit funny, the analogy that I'm going to be using throughout this presentation is an analogy of a whiskey warehouse. Think of yourself, think of a distiller that has a large warehouse of whiskey barrels, and then basically this video is going to use that analogy throughout there. So you're going to see name drops of that throughout there, and it'll all come clear as I go through the video. But think of this analogy, you're going to hear that analogy drop parts of this analogy throughout the video. So just giving you a heads up that that's the analogy, is a whiskey warehouse analogy. All right, so we're going to start with an overview of the PIIverse income strategy. I've got the image of what that video is that I put out there. It is by far the most popular video I have released. It's dwarfed all my other videos. I'm very humbled on how many people found it very interesting, and I want to thank you all for your interest in it. If you have not seen it before, I think it's very important that you watch that video before actually watching this one, because it does bring up a lot of my strategy, and then basically this ties into how my strategy actually deals with that. So it's sort of like a follow-up to that video. So if you have not watched it before, click up there. I'm putting the link up there. You can click it right now and go to that video right now if you want. And again, I explained earlier, if you want to still do this video first, down in the description is a link to this video as well. But let's go and try to do a Cole's note of it. So an executive summary of my PIIverse income strategy. First of all, it has three main goals. My strategy basically is one, to maximize monthly distributions. I'm currently set it at a more of a tangible level of saying I want to maximize my monthly distributions to be 3 times my living expenses. And I sort of set an arbitrary number that 10,000 is my monthly living expenses. So I'm hoping and trying to strive for a monthly distribution that exceeds 30,000. 2, I need to provide an income growth strategy as well. So that my second goal says not only do I have to maximize my monthly yields and distributions, but I need a strategy that it doesn't just stay stagnant and say, oh yeah, okay, I've hit 30,000 and I'm good to go. No, I need a strategy that will grow my income in the decades coming throughout my entire retirement, because at the end of the day, I have to deal with inflation that's basically happening at 2, 3, 5%. So you can't let your monthly income sit at idle. You have to have a strategy that will grow your income for that. I also want to keep trying to increase the buffer of my monthly income over my monthly living expenses, because the larger the buffer is, the more protected I am from any really bad downturns in the market, that basically my portfolio can ride them out because the buffer is much higher than my living expenses. So that's the second reason for second goal. My third goal is to minimize and mitigate risks to protect the portfolio's income. So the other two goals are very important, but if I don't have a strategy that protects my portfolio from risk elements, such as investing in all my money into one ETF or trying to focus only on extremely high yielding ETFs, I need to basically make sure that I have a strategy that guides myself in my portfolio strategy that says, no, you need to make sure that when you operate and execute this portfolio, that you are also doing it in a way that will protect you from any of the risk elements, like say a fund manager that's gone under, or an ETF that's gone down, or a commodity, or like Bitcoin or something. So that is the third of my goals. All right, I'm going to turn myself off because I don't think you need to see me talking here. So, by the way, like my haircut, I just got it done yesterday for you. Actually, I'm lying. I got it done for myself, but I could tell you it's for you. But anyway, this is my new haircut. All right, I'm off. You don't have to see me anymore. Okay. Now, the other thing is, so how do I deal with maximum? So monthly income is maximized by using high and ultra high covered call ETFs. Income growth is attained by disciplined monthly reinvesting and rebalancing. And this line item is actually sort of what the crux of this video that you're watching now is going to be focusing a lot of. So this is actually the important line item that this video is actually very interested in. And then thirdly, to deal with portfolio risk, I minimize it by aggressively having a covered call ETF diversification strategy, making sure that I spread my ETF holdings across several sectors, several geographies, several fund managers, yada, yada, yada. The more ways I can diversify elements of risk, the better. I need to make sure that they do not correlate with each other as much as possible. Now, that doesn't mean it's that they're not correlated. I mean, at the end of the day, if I have five ETFs that are all using Bitcoin, they're correlated to Bitcoin. But they are not correlated to each other in many other elements. So, for example, the 5 ETFs that are doing Bitcoin are coming from different fund managers using different ETF strategies. So what I'm trying to do is mix and match the ETFs on my portfolio so that they actually are mitigating risks of single different elements. My strategy here is that I, at minimum, have no more than 5% of any one holding. So that means I generally hold at least 20 ETFs in my portfolio. I currently hold, I think, 26 or 27. And finally, combining all 3 of these strategies, my goals are being met. So that is my PIIverse income strategy. And again, I encourage you to watch the video for more details, but that's the summary. So let's move on. Now, this is going to be this one's going to explain some of the most critical terms that this video is going to focus on, because we're really focusing on NAV and income. So in order to get everyone up to speed, because some people, yeah, I know what NAV is. And then there's some that say, you know what, I'm actually not sure what NAV is. So let's go through each of the terms, and I'm going to talk bullet points on each one of them. So the first one we're talking about is portfolio, your covered call ETF whiskey warehouse. So remember, I was bringing up the term that I'm going to use the analogy of a whiskey warehouse. So if the portfolio is basically the analogy of my whiskey warehouse, all the collection of covered call ETFs, each one a barrel filled with fine whiskey aging in your warehouse. So if you think of the warehouse as being my portfolio, every barrel in the warehouse is one of my ETFs holding the precious whiskey that is basically the income, and we'll talk about that later. So it's diversified across several risk elements for a balanced risk and income. So if you just heard me say before that I want diversification, this collection of covered call ETFs is a mix and match of several different kinds of ETFs, each one of them contributing a consistent flow of income, but doing it in their own unique way so that there's diversity on how each one of them produces their income and to what level. They all have different yields. So that's what the diversification my warehouse holds. And then they grow as monthly generated income is reinvested, which then expands NAV. So the portfolio is loaded with these ETFs, and because of using monthly generated income, using monthly generated income, I reinvest it so that I can expand the NAV. So in that case, expanding the NAV is like adding another barrel to the warehouse or filling one of the barrels that was partly empty back up again. So basically, reinvesting is expanding the NAV in the portfolio. This is the stage where all my compounding strategy plays out. So basically, this is the stage, the portfolio is where everything happens. 2 is basically my book value, my NAV book value. And I said slide 2, I should take away that slide 2. Sorry, apologize for that. Anyways, so the second term we're talking about is book NAV. Call that basically the aged value inside each whiskey barrel. So it's a cumulative value of reinvested income and capital. So the book NAV is all the assets, the value of all the assets minus the costs and liabilities that basically make up the cost of your portfolio. So if you have 30 ETFs and there's 100 of these and that, you have to add it all up of what you paid for them at the time you bought them. That is the cumulative cost or the cumulative value of all your investments that make up the portfolio. That is your book NAV. It grows steadily and is unaffected by market volatility because basically the NAV is calculated by every time you buy something. Once you purchase an ETF or another 100 units of an ETF in there, basically that cost is the cost it is at the time you buy it. It's fixed. It adds to the book NAV and the book NAV increases. So market volatility has nothing to do with book NAV. It basically rises and falls as you add more assets to your portfolio or remove assets from your portfolio. With my income strategy, generally everything is being added to my portfolio because I use a reinvestment strategy on a monthly basis. So my book value will continue to grow. This reflects the true depth of the portfolio's performance. So my book NAV is what holds it is basically made up of all my ETFs. My ETFs is what basically make up the value of my portfolio. Think of it as the rich, mature whiskey inside the barrels. Then the other one is, compared to book NAV, is the current NAV. So that is the level of whiskey in the barrel. And we're going to talk about that a little later. But basically, inside the barrel, the whiskey basically evaporates and goes down and goes up and stuff like that. So basically, current NAV is how much whiskey is in the barrel. Book NAV is when the barrel is full, and basically the current NAV says how much whiskey is left in it. And so as it rises and falls, that is actually the current NAV. It's the level of whiskey in the barrel. Real-time market value of all ETF holdings and assets in your portfolio. So this is basically, as of today, what is each ETF's current price or value, or each value. You add them all up and say, as of today, the value of your portfolio is this because these were the prices and the value of each one of the ETFs in your portfolio. And unlike book NAV, it is sensitive to volatility, to sentiment, and to options upside limits. So basically, this is the one that will go up and down like a yo-yo. Every day, I won't say every day, every minute, your current NAV is changing with your covered call ETFs because every time their value is going up and down. So unlike the book NAV that is basically at the time you purchased it, your current NAV is what's basically changing on a minute-by-minute basis. Often this lags behind the book NAV, and I'm going to use this thing I'm going to explain about later. It's like the angel share, and I'll explain it. There's a whole slide on it. But this is something with the income strategy using covered call ETFs. Generally, the current NAV will always lag behind the book NAV. That doesn't mean it always does. It generally will. It says here often. So it often lags behind, and I'd say almost always lags behind because in the long term, because covered call ETFs have a known limit, basically, which says that they are limited on upside. Capturing upside movement. Some of the ETFs that are more aggressive are missing out on some of the upside growth, and therefore they will not grow as much as the current NAV, as the book value. So you will see some drop on it, and therefore your current NAV will have a lag behind the book NAV. This doesn't affect the richness of the barrel, it's just what remains in the barrel. So that's what I wanted to sort of mention in here. Okay, important terms explained and continued. So unlike current NAV, a lot of people get current NAV and market price mixed up. This is what you see on the exchange. So where current NAV is basically the value of the assets inside your portfolio. The market price is what the value is at its trading price. And a better way to describe it is at an ETF level instead of the portfolio level. So if an ETF's current NAV is, say, $10, but when you go on the stock exchange, on the stock market and look and want to buy it, it says it's 10.05. That is the price that the consumer wants to pay for that ETF, even though its value at this current day, at its current price, currently that the NAV is at 10, the trading price might be 10.05 or it might be 9.99. If it's at 10.05, it's referred to as being at a premium price. If it's under 10, like 9.50 or whatever, it's at what's called a discount price. So, just to keep in mind that there is a difference between market price and current NAV. They can differ from current NAV due to supply and demand. So that's usually what's causing the variation. And they're influenced by investor behavior and volume. So current NAV is more mathematical, whereas current price is basically influenced by, a bunch of investors say, oh, I got to get into on that. I heard it's going to run. So it's based on behavior. So the price goes based on what the investors are willing to pay for it, no matter what its value is. And it does fluctuate often much more than the NAV itself. Because it's based on market movement, it actually could be moving up and down on a second by second basis. Often this is used as a close estimate to the portfolio's current NAV because it's a little harder to calculate portfolio current NAV. So a lot of times, like even in my spreadsheet, I'm actually using the market price and the number of units of every ETF. I'm using that as I'll call it my current NAV, but it really isn't the current NAV. It is, if I'm doing that, my spreadsheet is actually calculating current market price of my portfolio. But the two are generally pretty close. You'll get a few of them that might be out by quite a bit. But if you actually go and look on the markets, a lot of the companies like the mutual fund or the ETF companies will say the current NAV is this, the current price is this. And I've seen it quite often. They're like 5 cents apart, 2 cents apart. It doesn't mean that they're always, but generally they're usually tracking pretty close. But anyways, so a lot of people might use market price as a way of calculating their current NAV because it's just easier to use market price. So that's why. And then finally, there's income and distributions, or used interchangeably. Some people will refer to it as income. Sometimes they refer to it as distributions. This is the fuel that powers the growth of my strategy. Monthly ETF payouts from their generated options, premiums, dividends, and capital gains. So the income and distributions is basically the payouts from what they generated inside the ETF. And again, those are the primary things that they use to generate that cash that they can pay out. Of course, with covered call ETFs, premiums are from options contracts are their number one source of income. But if some of their underlyings also pays out dividends, you actually are entitled to the dividends that they pay out, and is also the capital gains. So the payout comes from those types of sources, but that's what the income is getting its source from your ETFs. It's consistent ETF payouts. So covered call ETFs and basically are very consistent. They're sort of mandated that they have to pay every month or every cycle that they say. Maybe it's weekly or if it's monthly. But what does vary is the amount that they pay each month. And some of them are pretty stable. Like if you look at a lot of the Canadian covered call ETFs, they're very stable. They're not only consistently paying every month, but they're also usually paying almost the exact amount every month. If they make a change, it usually changes like once a year or twice a year. But on the other hand, you look at the ultra high covered call ETFs like the Yield Maxes, the Defiances, and all those up there. Man, you don't know from declaration to declaration what they're going to pay. They're pretty much, if they're the same 1-2 pay periods in a row, that would be a shocker. So they do all pay consistently, which is very important to understand. It's not that they'll ever miss one, but they'll very likely in some cases be higher or lower. You don't know what you're going to get with some of them, but you know that each one of the ETFs in your portfolio are going to contribute to your overall monthly income. paid out cash. So basically, when they basically pay it out to you, you basically have two choices. You could withdraw it from your portfolio and basically use it for living expenses, or you could reinvest it to grow your book NAV. You could do both as well. So you decide. Once that money lands into your portfolio each month or whenever these ETFs pay out, you then decide what to do with the cash, because your portfolio, the ETFs have capitalized their income. And now that cash is yours. It's not theirs anymore. You can't lose it anymore, because that money has now been paid to you. You now decide if you want to withdraw it from your portfolio for living expenses, or if you want to reinvest it to grow. It's the fine aged whiskey in all the barrels in the warehouse. They're the whiskey that's coming out that people can now enjoy, or you could use it for reinvestment. So the key here, this is the key to the growth cycle. Distributions goes to reinvestments, which then grows the NAV, which then creates more income. So without this income and distributions phase, basically the whole income strategy doesn't work. The whole strategy on income or passive income strategies works on the amount, just the sheer amount of income and distributions that are coming out, which can then be used to continue growing your NAV, which again, of course, the lovely cycle of then creating more income. All right, so I want to actually visualize this. I'm hoping this will help. I drew this up back in my old IT days. I drew this image up to help people really understand and visualize what this cycle is. It's easy to say stuff in text, but I want to show this cycle because it's called the distributions NAV expansion cycle. And I want to show why the cycle basically is expanding not only your monthly income, but it's also expanding your NAV. All right. So there are two main elements, and I'm going to point them out to you here. So the two main elements are, first of all, the monthly income, which is up here, and the income portfolio, which is down here. So those are your two main elements in this cycle. So inside your monthly income, there are two subcomponents. One portion of the monthly income is the amount allocated that you, and again, there's nothing, this is arbitrary. This is the amount you as the investor have decided that I'm going to withdraw for living expenses. So this is your choice. If you decide you want all of it, the pie I've given is just an arbitrary example of how much. I've sort of set it to be almost like about a 33-66 split. But I mean, it could be 50-50, it could be 25%. It's your choice what it is. But this is the key part. You have to decide every month how much of the total monthly income that's being generated is going to be given to the living expenses. The second part is what's called the excess income portion. So whatever's not used by the living expenses, it's the income sitting in your cash balances that could be then used for whatever else you want. And we're going to explain what that's going to be used for. Inside your income portfolio, which is down here, is very thing. It's the diverse collection of covered call ETFs. So you could see, and I'm just using my portfolio. I mean, there's only a few here. I'd have like 25 or 26 of them. I couldn't draw that many dots in here. But this is the diverse collection of covered call ETFs that are inside there. And I want to show the one thing you can see in there is, well, we're going to talk about that right away. So I won't even let that finish. So the first step that happens is your covered call ETFs generate distributions. And that's what I was just going to say. So you can see these little blue lines that are going from each one of the covered call ETFs. They're heading towards the main flow up to the monthly income bucket. And you can see I've drawn different line widths because every covered call ETF is going to basically contribute to the overall monthly income in their own way. For example, if you go someone like a PLTY or that, they're going to generate $3 or $4 or whatever they are a month in their distributions. And then you got others that only have a yield of 10 or 12%, and they're just going to contribute like, where Platy might be contributing $2,000, one of my smaller Canadian stable ones might only contribute $50. So, but they're all putting their buckets together and generating one major cash flow of distributions up to the monthly income. And that's the dark arrow here. Once it comes into the monthly income, as we were saying here, the living expenses are withdrawn. So you now as the investor decides how much that you want. In my case, I generally have it set so that my RIFs pay out a scheduled amount. I don't even say what it is. On the 15th of the month, my 4 RIFs, or my 3 RIFs and my 1 LIF, basically pay out their scheduled amount every month. I can change it if I want. I can actually do a special withdrawal over top of that. Or if I decided that, you know what, for the next year I need to have more or I don't need as much, I can go back to my broker and say, change my monthly scheduled RIFs down to from 10 down to say 8. But it's basically you take that out. The first thing you do when you start the cycle after you receive your distributions is pay yourself out. Once that money is gone, what's left is your excess income. So the excess income is used to redistribute and buy more covered call ETFs for your portfolio. So here you can see it in this diagram here. So you can see that that money is then being drained out. It's being reinvested. The cash is being used to buy more ETFs. I do not use DRIP. So this is just this is the process where that reinvesting is happening. I basically decide, oh, I see there's a good deal on, say, Hui, or I'd say, you know what, I'm underweighted on HPYT. It doesn't matter which the ETF is. But what happens here is this is where I make a decision on what new ETFs am I adding to the income portfolio, which then adds basically another stream of income into my portfolio towards my monthly income. And again, it could either be adding more units of an existing ETF, or I could be adding a new ETF. So let's just assume this is a new one and hasn't done its first payment yet. But basically, you're redistributing so you can add ETFs into your income portfolio, which of course, during the next cycle, it's just going to you now have a larger group of covered call ETFs to generate more monthly distributions, and you repeat the entire cycle. So now with the larger group of covered call ETFs, more arrows are heading towards this, and the little lighter blue shows that your distributions have now expanded. So you have expanded your NAV, and you've definitely expanded your book NAV. And of course, as soon as you expand your book NAV, you have expanded your current NAV, because if I'm adding $20,000 of another ETF into my book NAV, my current NAV has on that day gone up 20,000 as well. So when we say that we're expanding NAV, we're expanding at that time, we're expanding both book NAV and current NAV, because they both have to go up on that day that you buy it, because they both are going to count that you've now got, $20,000 more of ETF 135. All right. So you do rinse, repeat. It goes in here. You do your living expenses. If that stays the same, here's the thing. You know that you've gotten larger monthly income. So your excess income now is even larger, because if your living expenses stay the way they are, that means you have more money to spend because you didn't increase it here. So that means your reinvestment bucket gets bigger. I should have put a light blue here, meaning I could buy even more covered call ETFs because I didn't use it for expanded living expenses. And that is the distribution NAV expansion cycle, where distribution and NAV is expanded every month. So this is the first key element of what I was talking about NAV. Why do I not worry about NAV and NAV erosion? That's the first element, is because I am on a monthly basis increasing my NAV value. All right, so let's talk about book NAV. So how does my book NAV grow? And this is where the role of monthly reinvesting is in another image. So I showed you the cycle, but I want to show you the chart. Now, I'm going to show you this chart down below, and I'll explain a little bit further, but this is the image that we're going to be using. So my PIIverse income portfolio is self-funded. Some people ask me in my questions, you're not putting any contributions into your portfolio? The answer is no. My portfolio, my income-based portfolio, is self-funded. If it's growing because it's using its own generated income to grow itself. So that's an important thing to know. I don't need to contribute to this. It's growing on its own accord. So to meet my goal of a growing monthly income, reinvestment is absolutely critical, because I can't grow my monthly income if I don't add more assets and more ETFs to generate more income. So reinvestment is a critical element of it. The other one is rebalancing, but I'm not going to get into that one. This one's going to focus on the more important one, which is reinvestment. The amount to reinvest is not static and can vary each month based on the living expense needs. So I've already explained to you in the previous slide that basically, I've had some people ask me, well, what's the rule? How much do you have to reinvest in order to keep your NAV stable? Is it 30%? Is it 20%? I don't actually know the answer to that. I look at my NAV, and if I feel that I don't need the living expenses, so my rule is more the other way around. My rule is that I withdraw all the income that I need for the month. The rest is basically reinvested. So I don't believe in money sitting idle. I know some people say, well, build a big stockpile for emergencies. I mean, my emergencies is if I really needed money that urgently, that I couldn't wait for income to show up, I could always sell an asset. So I don't worry about that. If I have money sitting around idle, it doesn't sit around idle for long. I basically reinvest if I didn't use it for living expenses. Now, that being said, the answer of I'm going to use all my money for living expenses and not reinvest at all, I don't do that. First of all, I don't need that kind of money, because currently my portfolio generates between almost $50,000 a month. I don't need that, nor do I want to be taxed to death when I try to take it out of my sheltered accounts. So that's the first reason why I wouldn't withdraw all the money every month. But the other thing is, it would be stupid of me to not use this excess income to help continue growing my NAV. And of course, because that means growing my income. So I know I have to reinvest something. I generally try to reinvest at least 30 to 40%, but generally, unless I'm having a major like home renovation or something where I need, say, $200,000, I'm generally contributing almost 50 to 60% each month into my book NAV. Again, not because I have to in order to stabilize my NAV. It's because I don't need the money for anything else, so I basically reinvest. Somebody said, well, you have to do it. No, I don't have to reinvest every month. I have in 2024 basically 3 months in a row where I withdrew every penny out of my reinvestment for the month, out of my portfolio. So for 3 months in a row, I generated income, and I pulled all the money out of it for 3 months in a row because we were doing a major kitchen renovation. And basically my portfolio had to pay for all of it, and it needed 3 months of that income. And so I had 3 months last year where my portfolio got no reinvestment contributions. Again, my portfolio dealt with it. Yeah, the NAV didn't grow that much for the next 3 months. But again, I'm not worried about it, because at the end of the day, my NAV, at worst case, it stayed stable, maybe even went down a little. But again, I'm not worried about it, because I know that as soon as I start reinvesting again, it will continue growing. So without continued reinvestment, book NAV rises directly proportional to the amount. With continued reinvestment, I said without. With continued reinvestment, book NAV rises directly and proportionally to the amount that was reinvested. And now I'm going to talk about this chart. So below is a simple straight line chart showing book NAV growth of my actual portfolio from December 2023, when I would say was the inception of my mature strategy, to basically December of this year. I basically projected out based on current growth over the last 8 months, but this goes up to December 2025. These numbers are actual numbers. It's not that beautiful straight line, but I didn't want things to get too complicated. I basically did year to year to year expansion, so you can sort of see that my book NAV is growing. Not only is it growing, but what you're seeing here, these little green humps that are happening over and over and over, those are my monthly reinvestments. So basically, my monthly income builds up some cash balance here. And then as soon as I have enough cash balance, I actually use whatever I need for living expenses. And the rest of it is then basically used to reinvest back into the portfolio. And the reason I'm showing it this way is because when I go from here to here, and I'm going to go to a bigger area. So if I go from here to here, yes, I reinvested. And by reinvesting, my NAV grew. So my NAV grew. My NAV grew. It actually should be more of like staircases. So the reason I'm showing this is that every month I'm reinvesting. Every month my book NAV is growing. And that's what these little humps are. The other thing I wanted to show, and I'm not a good drawer, is that you can see that the humps are getting slowly but surely bigger. Because if my income is growing every month, that means that my living expenses are relatively stable. It means that my portfolio or my income's excess income is growing. And if I have more excess income that I don't need for anything else, that means I can actually invest even more. So now my reinvestment cycle is getting larger and larger and larger, which then basically means my portfolio will continue to even grow faster and faster at a very slow pace. It's not as if it's going to skyrocket here, but it will start gently sloping up at a higher and higher speed as my portfolio NAV generates more income, which means I can invest more. And that's all I really need to show in this picture. This is how book NAV grows because of monthly reinvesting. So what you see here is just as actual numbers, because you can't actually see the actual numbers. By December 2025, my book NAV will have increased from inception, from December 2023, by $635,000. It's grown $635,000 since December 2023. And it did that while it was also paying out $615,000 worth of withdrawals to date. So not only did it pay me $615,000 of actual income, it also increased its NAV by $635,000. So it's doing both. So when I go back to the title where it says you're mastering income and NAV growth, this is sort of what I was trying to say. All right, so now let's talk about the boogeyman, because there's a lot of naysayers. A lot of people are talking about NAV erosion and it's evil and your strategy is not going to work because, it's only a matter of time before you're going to erode to nothing and wait till the next market crash happens. And so this is basically the next few slides are going to tackle all the more boogeyman questions about what about current NAV? Okay, sure, your book NAV is going up, but how about your current NAV? So let's talk about that. Current NAV fluctuates greatly based on global market conditions, sentiment, and specifically with my strategy, because I'm holding covered call ETFs, it definitely fluctuates because of covered call upside limits on the more aggressive ETFs I have. Again, I mentioned this earlier, the more stable, lower yielding covered call ETFs aren't really as impacted by upswings, but they do have some if the upswing was very aggressive. But generally, they're not as susceptible to it as some of the more aggressive ultra high yields. But this definitely will impact current NAV. Due to the current, this is what I was just saying, due to the current, the covered call ETF's limits on capturing upside market swings, current NAV will often lag behind book NAV over time. So I'm not saying it doesn't happen. There are times that maybe if you've got just the right mix of covered call ETFs, let's say they're all stable and they're really tracking really close to the book NAV, and then all of a sudden the markets go flying up and your ETFs actually increase in NAV value. You're basically going to see in many cases, and you can see over here, it actually was. My book value was less than my current NAV. But in most cases, over the long period of time, my strategy basically will see a slow but sure, what's called NAV lag, current NAV lag. If you look on this spreadsheet, we'll get to that right away. So the size of this lag is directly related to the types of covered call ETFs you hold in your portfolio. I just mentioned that. the more income aggressive the covered calls are held in your portfolio, the greater that this NAV lag will occur. And the NAV lag, if you're looking in this, the NAV lag, if you're looking at this chart already in advance, it's the gap between the yellow and the blue. That is the NAV lag. All right. Now, I'm calling this NAV lag the angel share, and I'll explain it into the next slide because there's something important to know about this. But basically, this is the gap where you're basically your covered call ETFs. There's a cost of holding these covered call ETFs. Again, I consider them acceptable, but again, it just should be known if you're going to have a portfolio that is literally all about covered call ETFs, you have to expect this quote unquote NAV lag, or I'm going to refer to it as the angel's share. And again, it's a good one, but I'll explain it to later. So here are some important notes, what you're seeing here. And this is the thing. First of all, current NAV will trend to grow with the book NAV, even if it's increasing in lag. So the first thing I want to point out here is that, yeah, your book NAV is growing, but no, your current NAV is not. No, it is. And this is actual metrics. So this is not me just drawing a picture to prove a point. You can see that even though my current NAV is behind or lagging from the book NAV, that area right here, it is still growing. Matter of fact, it has grown $230,000 beyond its inception. So since December 2023, my current NAV has grown $230,000 above what it was when I started. Again, it's not the 1.8 million over here. It's only at the 1.58 million. But at the end of the day, my current NAV is still growing, even though it has lag. The other one, and this is the more important one, which people keep calling out, there is no current NAV erosion. It is clearly growing. And again, I want to show this here because in this diagram, you can see if there was NAV erosion, first of all, would have to show that since inception, my current NAV should be declining. I've had this for 2 years. So if the theories are right from the people saying that, no, your portfolio will erode, it's going to erode because you got covered call ETFs, they will erode. Well, I'm proving it to you right here on this chart that is absolutely wrong. There is no portfolio NAV erosion. There is definitely a current NAV lag behind book value, but there is no erosion. If there was erosion, I would have to be below this red dotted line. My portfolio right now, the current NAV is above the erosion line by $230,000. I'm also going to point out that going under this red line does not mean it's erosion either. And I'm going to explain that. You're going to see the reason what I mean by that in a couple slides. But I don't know if I can say this any more clear. There is no NAV erosion on my ultra high yielding covered call ETF portfolio. You can see it right here. I don't know what more facts you can have, but you can see it right here that I do not have current NAV erosion. My current NAV is growing. It's just growing slower than my book NAV. And again, I don't worry about it because the important thing for me as an income investor is that my income keeps growing. These humps that are growing, this is the part that actually I care about. I want to see these humps get bigger and bigger and bigger. And that's going to happen because my book value and my current value is going to keep growing. As long as I put more income generating assets in my portfolio, it's going to generate more income, and then I could basically reinvest and increase the NAV more. So again, I hope people can see this. If anybody tells you that these covered call ETF portfolios will NAV erode, they will not NAV erode. Now, I've been hinting about this angel share, but because I found it to be a neat analogy of explaining a current NAV lag, because I know some people, the naysayers about covered call ETFs and strategies that use it, are going to right away, because I've actually sort of proved to them now that there's no such thing as NAV erosion. The next thing they're going to jump on is, yeah, but you're underperforming because your NAV lag you're saying it right there that your current NAV is declining over your book NAV. Okay. Again, since my portfolio, my entire strategy is to generate income, I don't care if my current NAV is lagging behind my book NAV. Again, it's not a big factor. All I care is that my current NAV is constantly going up. I don't even care if it goes up 1% a year, as long as it's not showing a decline and constantly trending down. I just care about the NAV, that the current NAV is generally in a long-term trend heading in the right direction. Now, that being said, let's talk about what the current NAV lag is, because maybe this analogy is going to help you understand it, and maybe it'll be interesting for some of you. So, imagine your portfolio is this grand whiskey warehouse. It's all coming together now, people. Inside are rows and rows of these aging whiskey barrels. And if anyone's seen what, a whiskey distiller's warehouse looks like, it's this massive warehouse with tons of barrels, because they all have to sit there and age for 5, 10, 20, 16 years. So they're all in this warehouse with all this thing. All right. So consider each one of those barrels in that warehouse to be one of your cover call ETF. Each one of those barrels, each one of those cover call ETFs has its own character, its own yield. When you look at it, it will taste differently. It does different things. So think of each of those barrels as their own cover call ETF sitting in the warehouse aging in order to improve in their flavor and their character. And that's why they age it, so that the whiskey that ages longer, more years, actually tastes better. Okay, so as months pass, the whiskey matures. The barrels deepen in their flavor and value. So that's just like saying that as time goes on, your book NAV increases, which will steadily grow as monthly income is reinvested across the warehouse. So as you're adding more barrels into the warehouse, you're basically having more of them age and basically letting them age. But this is the twist, and maybe some of you people don't even know this, so this maybe be a new little educational thing for you. There is a twist when distillers age their whiskey. In the whiskey aging process, a small portion of the spirits evaporate from each barrel. It does it because if the barrels can breathe, and when they breathe, the alcohol basically starts evaporating and leaving the barrel. Distillers know that they fill up the barrel, and then 10 or 12 years later, 20% of the barrel is empty because that portion has evaporated. The distillers know that's part of the business. They referred to that as the angel's share. It's a poetic way of saying we're giving this part of our beautiful whiskey to the angels. So they refer to it as the angel's share. It's poetic, it's expected, and it's an accepted loss. They don't sit there crying about it. They know that as the barrels age, they're going to lose some of the content. That is the NAV. So it's simply part of the process. When you basically make whiskey and improve the whiskey's flavor, you have to let it age. And when you let it age, you lose some of it, and it's going to the angel's share. The reason I want to bring it up, because think about that angel share as being the current NAV lag. So angel share is current NAV lag. The market volatility, capped upside growth, and short-term sentiment causes the cover call ETFs levels to fluctuate. To make a fine whiskey, you just have to accept that there is an angel's share. So as opposed to sitting there, and I know a lot of people are just going to say, no, I can't find that acceptable. As an income investor, I accept the angel's share. I know that NAV growth, the current NAV growth will lag behind book NAV growth. But as long as my goal is met, which is to keep increasing my monthly income, I'm more than willing to give the angel's share to whoever it is. But because at the end of the day, I'm meeting my goals, and let the angel's share be. The other thing you should also know that the angel's share is unique for each barrel and for each cover call ETF. So some, like I'm going to use like the Canadian cover call ETFs that are very stable, very, they don't write contracts on a lot of their underlyings. The angel share for them tends to be a lot smaller. So if you just bought a lot of covered calls from very stable, low yielding, like 10%, 15%, 20% covered call ETFs, chances are your angel share or the current NAV lag will be very small. Now, You're saying, well, Perry, well, if that's the case, then why don't I just buy all these 10 and 12 and 15% covered call ETFs? Because then I don't have to worry about giving anything to the angel share, or very little to the angel share. The problem with that theory is, in order to generate more income, to generate higher yields, you have to be more aggressive. And in order to be more aggressive, you have to basically accept more angel share. More current NAV lag will happen for something like a yield max covered call ETF than for something like I'm going to say down, HDIV or one of the ones that are very stable. So, but there's no way an ETF like HDIV is going to generate the monthly income that basically something like a PLTY or a Coney or an MSTY will do. So that's why my portfolio, the strategy of diversification, allows me to both sample having ETFs with very small angel share and some that have very large angel share. In general, the portfolio comes up with a consolidated angel share, and you saw it on my chart earlier. That angel share to date is $250,000 out of my $1.6 million portfolio. And just like a master distiller knows not to panic as the angel share slowly rises, because it will slowly rise, it's just a matter of the process of the strategy, you have to know that strategic reinvesting of excess income continually adds barrels, which then expands both your book and your current NAV. So the angel share is a very small portion compared to your monthly reinvestments back in. So you're reinvesting more than the angel share is taking away from you. And that's why you saw in the last chart, you saw that the NAV growth and even the current NAV growth was growing, because you're basically reinvesting more than the angel share is taking away from you. And again, you're doing this so you can generate more income inside your portfolio. Over time, the warehouse fills up with more aged value, and as does the income generated from each barrel that you add or each ETF you put into your portfolio. So I was just saying that already. I sort of spoke ahead of my screen here, but basically, you're not worried about the angel share because you're adding more barrels that is countering that angel share and actually generating much more income than the angel share is taking away. So I am not worried about the angel share. So while the angel share always exists, the warehouse grows larger and more resilient with every cycle you put in. And again, that's sort of self-explanatory. So that's the power of your strategy. Long-term NAV growth fueled by disciplined reinvestment. Even when the current NAV lags behind the book NAV, both still grow. So let's talk about the last one, which is a concern brought up, again, unfortunately, by some of the naysayers that just don't believe in covered call ETFs. More power to them. If they don't believe it, I'm not there to convince them. But I want to address it for those that actually hear these kind of sentiments and then say, oh, I've heard all this bad news about them. Well, let's talk about the next elephant in the room. And the one thing that was brought up all the time was, oh, you wait, Perry, when we have the next big market turn down or downturn and the markets are down by 15%, that's when your portfolio is just going to collapse. And I say basically no, because all they're doing is based on theoretical projections that's going to happen. I'm going to use an actual example. Again, not as long term. Again, this is not the pandemic of 2020, but it is definitely an example that just happened just this year. And again, not as extreme. I mean, it was extreme, but it wasn't long lived. But it shows what my portfolio does when a significant downturn happens in the global markets. All right. So again, I brought this up. This is what we're going to talk about. So based on shorter periods of historical downturn events, so I don't want to just based on me guessing what it's going to do. I'm actually using an actual mini event that happened, and it'll help you maybe get a good idea. So the projections could be made based on that mini event that happened earlier this year. So during a market downturn, this is what generally you'll experience if you are a passive income investor using covered call ETFs. The first thing is book NAV will continue to grow. as reinvesting will continue as well. But the amount that's reinvested, the levels that you're going to reinvest, they could drop. And the reason they could drop is because the other thing I'm going to point out, I should have put it in a different order, and we'll talk about why they should drop. Current NAV would clearly drop, as would any equity in any other markets drop. So this is not something that's unique to covered call ETFs. So basically, like what happened back in April, March during the tariff days there, we saw a major significant downturn. And when that happened, all the markets went down. Even if you had stocks and stuff like that, they went down. And of course, so did my portfolio. So my portfolio, this is using actual numbers that happened. So I actually put the details in here. So when that happened, my portfolio actually dove into what's called the NAV erosion area. And again, the clear thing to point out is it's not erosion. It's only erosion if my current NAV actually trended down and kept heading in that downward projection. So that is, NAV erosion has to be something that is always getting lower and lower and lower and lower and lower every month. This is not NAV erosion. This is basically a temporary NAV decline. I dropped down to about $1.28 million when I was already up at $1.55 million. So I seen a significant drop just like everyone else did. And then, of course, it took a couple of months for me to get back up. But by about July, I was right back to where I was again. So the first thing you should notice is that it did come back up. The other thing is dropping current NAV would naturally drop monthly income. So I jumped ahead of myself on the recovery. So because current NAV dropped, the prices of the underlyings in the ETFs have dropped in price. And because of that, that means that you're going to see lower contract proceeds because they're writing contracts on lower priced underlyings. So you're going to see a drop in your monthly distributions. Just to give you an example, I thought I drew it in here, but I didn't. My income dropped from before that happened to when it actually happened. I was already almost at 40,000. I was about 39, 40,000. And during those 2 months, my portfolio monthly income dropped to 34,000, 36,000. So it almost went down exactly like the chart happened. I saw 34,000 on 1 month, and then 36, then 37. And then you saw the slowed increase happening. And by the way, that because my income dropped down from say 40 to 34, obviously, even though I want to invest and take advantage of some deals, the problem is that I didn't have as much to invest because my income wasn't as much. So yes, I still was able to reinvest, but maybe not at the same level I was before the market dropped. Then reinvestment, the other thing that's key about this is while I am in the market drop, so while I am way down here, the benefit of being down here, because everyone's like, oh yeah, now they're down and now you're really in trouble. Well, no, because the good part about being way down here is I'm still generating some really good significant monthly income. I can now buy ETFs that were way overpriced or at a high price. I can now buy them at 10, 15, 20% off. So usually, and I know all the other covered call ETF strategy investors in Blossom and that say the same thing. When the markets crash down like that, that is buying time. That's when you could go out and buy some great covered call ETFs at a much lower price. So you're actually building up your book NAV, and your current NAV is being built up too. But what's really nice is because you know that the markets are going to rebound and come back up, those covered call ETFs that you bought way down here are going to fly up. So you're going to actually see the recovery happen just like anything else that's going to happen, like stocks will happen by the end of the cycle. And again, if this lasted a year, fine, it would be down by a year. If this one only lasted 2 or 3 months, fine, I'm back up here. But at the end of the day, contrary to what people keep saying is that, oh yeah, when the big market comes, you're going to crash. No, I'm not going to crash. Basically, their underlyings, they'll go down just like a stock goes down. Yeah, do I want to see it? No, of course I don't want to see it. But at the end of the day, I know that I'm still generating monthly income. That's why I do 3 times living expenses. I can survive with my income only being 30,000. as opposed to 45,000, because I know my monthly income needs for living expenses is only 10 or 15,000. So I'll wait. When the markets recover, so will my covered call ETFs. So again, let's not listen to all the FUD about, oh yeah, when the markets crash, that's when your covered call ETF strategy is going to collapse. No, it won't. It will just do exactly what it did this spring. And again, as upon market recovery, the current NAV will return to its near original gap position. So again, it will not bring it back up to book value. It'll likely go back to the gap that it was before. So the expected lag gap will likely recover. And again, the reason it will recover, even though you're not going to get a lot of the upside growth, because remember, covered call ETFs have upside limitations. So you might not get all of the upside on its recovery. But you got to remember, you bought a lot of covered call here at a great deal. So where you lost on that, you gained on here. So again, it's all a moot point. It's going to be netted out to zero. So chances are, basically, your covered call, your portfolio will return back to the same net lag gap position that it was after or before the downturn happened. And again, this is hypothetical. I don't know, and nobody else knows. Anyone, we'll see what happens if another pandemic happens. But at the end of the day, this is what happens in a normal down cycle, and I'm showing you to based on real facts. So, long-winded Perry talks again. Sorry for making it a long video, but I'm hoping it helps clear things up. So let's go through here. I hope this video made everything a lot more clear about, one, why there is no NAV erosion in my income portfolio. I think I made it abundantly clear. Anyone that says that there is NAV erosion after this, again, I'm just going to call them trollers and people that just want to be troublemakers, because at the end of the day, I don't know what more I can do to show that there's no NAV erosion in my income portfolio. And secondly, why I'm not concerned about portfolio NAV. And, why am I not? That's why. The strategy protects both. I'm also sure, I'm sure this video will generate a lot more comments and questions about my strategy. I do try to read most of the posts, and I have been trying to respond to almost all of them. Again, as my channel gets more popular, I have to admit it's going to get harder and harder. But I will keep trying to read them, because actually it fuels me for new videos. Because if I still see people talking about certain questions, I can at least now say, oh, okay, there's still a lot of nagging questions about that one. I'll write another video that actually will target that. So please keep your questions coming. Keep posting on my comments below on this video or all my other videos. I'm hoping you're going to watch my other videos if you haven't. And the other thing is, please, creating these videos take a lot of time. This one alone took me 3 days to actually structure, and build and program and record. I hope you found this video informative and entertainment. And again, I so appreciate if you would press the subscribe button below. Because I promise I'm going to keep trying to create more content about my journey. But again, as an appreciation for the work on these videos, it really would be an appreciation if you subscribe, if you did find this content valuable. And until then, stay safe, stay investing, and I'll see you in the PIIverse.